purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, so let's see how things are doing. First of all, any burning questions here? Yeah, CL, what a nasty thing that's being. Let's take a look at that in a minute. Okay, let's see how things are going. It's talking about hurricanes. There's what, more hurricanes coming, right? We've got those are the old hurricanes. We've got new hurricanes to worry about. Whole new set. All right. Okay, here we go. As you can see, I'm having a terrible day. Let's see. We have this stupid thing, the Russell, is down $11,000. And my oil trade is just as bad. Nah, my oil's not as bad because I went in and out of oil, but it's still going to be bad. CL. And, no profit or loss because it's Colgate. I don't have Colgate. I wish I did. That would have been better. There you go. So oil's down. Well, for the day, I was ahead, and now I blew what I was ahead, and I lost $9,000. There's a $12,000 move against me from here to here. So that's not cool. But my attitude is everybody's excited about the Fed. Thing goes to here. It's all Fed excitement, and it's going to wear off. So, definitely, for sure, shorting at 51 up here. It's now 50.80. That's an easy one to get into. The Dow. Now, don't forget the Fed comes on soon, so the Russell, I figure, isn't going to go higher than 1450 without pulling back. And I only need 1435 to get even, so it's not like it's out of control. It's just it's like to have a lot of contracts. Apple drags the NASDAQ down. So really, you got to ignore the NASDAQ because Apple is down like 2% today, which is a big move down for Apple. And that, let's see, Apple is 15% of the NASDAQ, so just Apple alone accounts for the entirety of the NASDAQ's fall. So everything in the NASDAQ can be fine, but if Apple goes down 2%, the whole NASDAQ can look like this. There's no way around that. So that's what caused the NASDAQ to drop. So usually we don't ignore the NASDAQ, but, when Apple's dragging it up, you got to say, okay, it shouldn't go up that much. And when it's dragging it down, you say it shouldn't go down that much. It's the same thing. Oil is very interesting. This spike, I have to believe, is trying to blow out the shorts on the current contract so people can get rid of the shorts before they start selling. There might be a lot of shorts on. I'm one of the shorts. Except I'm on now. This contract is the. Let's see if it says so. It's the no, it doesn't say which one it is, but it's the X contract. It's November. Here I'll show you. CLX7 is the November contract. We're done with the other one. The other one's about 50 cents lower than this, which is actually just 50.30. So honestly, we're not really much worse off than we were like a week ago. We're sitting 15 testing it, but that's where we are on that. So oil's been very strange. Usually it's very reliable. It sells off into like the last day. We had a big push, and we have to give these guys more credit next time. I didn't think the push would overwhelm the contract, but the way they just were relentlessly with the OPEC is going to extend their cuts, and we're going to go to war with Qatar, and then Trump was the killer yesterday. Trump, really sewed things up for the oil bulls by essentially telling Venezuela, an oil-producing country, doesn't like them. Not North Korea. Who's the other one he was talking about? Iran. And then Iran, he starts coming down on also. But you can't cause trouble with two of the biggest oil producers in the world and not expect it to affect the prices. So that's Trump's UN speech was basically one of the reasons that we sustained a higher price than we thought. But this is got a month for this contract, so I'm pretty confident that over the course of the month will be quite a bit lower than this, unless he actually goes to war. But I'm pretty sure Trump's all talk and no action. He certainly has been so far with every other promise he's made, so we'll see what happens. Coffee, why is this chart so weird? Oh, because it's a dead chart. It's not the current contract. Coffee made a nice comeback. We were talking yesterday about how it was a good entry opportunity, and coffee came back nicely. There's weird stuff going on in the metals. Let's look at the other charts. I don't think they have iron ore in here, though, unfortunately. No. Anyway, so look at platinum. I think this is a weird thing with platinum because platinum is used in catalytic in the things. In electric cars use platinum, and all cars use platinum. So if you think about in the catalytic converters, they use platinum also. And if you think about like how many cars insurance-wise have to be replaced, it's going to be an uptick in the orders for the raw materials. Now, on the other hand, though, this is a weird thing because Ford just announced that they were closing. Where's still stop loss? Ford just announced. I just did the news, so we'll see what it was. BTG. Oh, we got to talk about that one. Cheesecake Factory. I love that. Oh, Ford is cutting production at 5 plants. That's kind of weird. I mean, not a huge cut, but, it's a little bit interesting. It's like why Fiestas and Fusions are not selling. It seems like what they're saying right here. The sales have been shifted. So in other words, it's not really Ford's not selling anything. It's that people are buying more SUVs than they expected. And that's extra weird considering how gas prices have been shooting up, too. Oh, speaking of prices, though, we need to look at that the petroleum status report. So let's take a look at that. Now, the excuse for oil going up is that OPEC's extending their cuts and the hurricanes disrupted supplies, but really there's not a big deal. We're seeing very little effect on the whole. And we'll see that here in the extended report. Plus. Okay. So today we had a build of 4.6 million barrels of oil and a gasoline draw of only 2.1 million with all those refineries offline. This is through, through September 15th, so through Saturday night, is that? 15th, Friday night. So through Friday night, so that includes both hurricanes, only a 2 million barrel draw of gas. That's really weird. And it's even weirder when you look at the product supply line. We'll get to that in a second. And distillates went down by 5.7. Now, maybe the refiners shifted to more gas, but they didn't. That's the weird thing. They made no effort whatsoever to produce more gasoline. They produced 9.5 million a day last year. They produced 9.5 million a day 2 weeks ago, and they produced 9.5 million a day last week. No variation at all. Distillate, no variation at all. Distillate production on the whole is up a bit. And so probably good for the airlines. They're probably flying a lot is what the answer is there. And other products, notice a big difference in other products from last year. Down 300,000 a day, 2 million barrels a week less other products. So I guess given the outages they had, they shifted more of their production to distillates and gasoline and away from other products, which nobody's really, screaming for. And you can see here, all other oils had a draw of, because they made less of it, all other oils had a draw. But gasoline down a teeny tiny bit, oil down a teeny tiny bit, same as last year. We're the same amount of oil we had last year when oil was much cheaper. 474 here, 472 here. 225 here, 216 in gasoline. A little bit less gasoline. But again, the refineries were offline, so you kind of expect that. And they're still exporting 1.4 million barrels a day. How do you say you don't have enough oil or anything when you're exporting 1.4 million of it during a hurricane? During refinery disruptions, we're still sending it out of the country. So our refineries, see, I thought that would be a variable, but it's not a variable because they're still sending it out of the country. At some point, you say, well, geez, gas prices in the U.S. spiked 30%, but we're still sending gasoline out of the country because we don't think we need it in the States. It's such bullshit. The problem is that they lifted the restriction on how much they can export, and these guys have just gone hog wild and exporting. It used to be that you weren't allowed to export a lot of gasoline. Now they can, and they just export as much as they possibly can. It's really terrible because it just screws the American consumers over completely. Last year, gas was $2.25. Now it's $2.60, so that's up 40, about 20% more than last year. That's wholesale. Now at the pump, I know we're paying like $2.75 right now, and I think last year, I don't remember exactly, but I think it was a lot closer to $2. So probably 30% of the pump. That's a little nasty. Sure, some of you guys in the hurricane states have seen some incredible prices. Latch is nervous on TF. Anyone else knows USO has insufficient short? Yeah, because I think a lot of people in my position are saying, screw you, I'm shorting. I'll look at the chart in a second. Yeah, Florida had a big road trip. That's one thing. But then they didn't drive for a week, right? Because then, there's the road trip aspect I agree with, but then it was kind of offset by all the planes being down and kind of offset by the fact that people kind of weren't going out or anything or doing much else once they got back. So I don't think it was like as much as, I don't think they used particularly more gas in a 7-day period than they almost would have if they just stayed home and drove around like normal. I think driving to, Atlanta to get away from the storm and then coming back versus if they stayed home and drove 50 miles a day, I don't think it's hard to I don't think it's really enough difference to put a dent in the needle compared to all those planes being grounded and refineries offline, the tankers and the tanking, the shipping. Oh, that's the other thing, imports. Where'd that thing go? Imports. Yeah, look, here's the thing that's happening is the imports, because of the disruption from the hurricane, 1 million barrels a day less oil is being imported. 1 million less barrels than last year is being imported per day. So 7 million less barrels per week coming into the country, and we're still getting bills in oil. Yet they tell us there's a shortage and they have to raise prices. Okay, we have a build, 4.6 million more barrels of oil, but we're exporting 1.4 million a day. That's like 10 million a week. All right, 10 million a week. So we're exporting 10 million a week. We are importing 7 million a week less. That's 17 million barrels per week less. And we still have a 4.6 million barrel build. And they're trying to tell us there's a shortage. So that's why you can't short USO. I have a feeling this is a gigantic short. So I probably think there's a lot of people on my side of the trade. And we'll see, though. I mean, I can get totally screwed on this thing. But I just don't believe in it at all. I don't believe in this either. I think there's a lot of crap in these numbers. Everyone's excited ahead of the Fed, but all of a sudden a little bit of profit taking. But this happens all the time. The market runs up into the Fed and then falls apart. When was the last Fed meeting? We're done with this, right? FOMC meetings. I think it was August 29th, if I remember correctly. August or July 29th? No, it must be July 29th. Yes! July 26th. I was so close. All right, July 26th was the last Fed meeting. So let's take a look at what happened on July 26th. I don't figure out why I start coughing when I'm doing these webinars. I don't usually. I can't talk too much without stopping. Let's see. So oil-wise, July 26th. Not going to show up on that chart, unfortunately. July. All right. So, see, oh, now that's not good, though, because we ran up into the Fed meeting, obviously went up higher into the very end of July, and then it took a long time to trail back down. So that wasn't good. That's not a good. That will not be a good profile for us if that keeps going. So I'm hoping we're peaking out now, and we'll get the same basic thing where the run up into the Fed is completely reversed. And if the run up into the Fed, which I would have to say would start here, and if we reverse back to 40, I'm going to be a happy camper. I'm at what's my average? My average is where is it? 54.50. No, that's not right. 50.50. Sorry, 50.50. So my average is here. So if we get to 48, that's $25,000. So I will be happy. So, and that's why, like I'm minus what? -9 right now. So, -9 right now, but my intention is to make 25. And if we had gone past 51, I would have gotten out of 5 and waited and then doubled down when we got up to like 51.50, tried it again, stopped out a half, got out again. I'm sort of laddering into the position. I'll take a bigger position if I get it even cheaper. Even if if we get to $55, I'm going to have a huge amount of these shorts. But we're not getting to 55, I don't think. So I'd rather play here and just make sure I have some contracts just in case we get the pullback. And same with the Russell. I'll put more on if I have to. So I guess I could say I have conviction on both of these. Anyway, so we have this run up, and then everybody fades out. Now, on the indexes, S&P is a little more reliable if we look at something. We ran up into the Fed and then immediately sold off after the Fed. That's July 26th. And then drifted, fall, and now we're back up. And that's what happens. You're coming into the Fed meeting, everyone's like, oh, Fed meeting, they're going to fix everything or whatever. I don't know what people think they're going to do. It's a constant thing, though. All right, when was the Fed meeting before that? June 14th, May 3rd. So June 14th, middle of June, see? And again, sell off. May 3rd, kind of went, actually this one was good. They went up a little bit, but then we had the big fall later. So, but the Fed tends to inject, well, actually it's not, we had this run up into the Fed. So it did calm down, and then it went back down. This was the run up into the Fed, though, for May 3rd, because it's only right here where we had that meeting. And then June 14th is this one, is right here. And again, you have a run up, and then kind of drifts into it, and then a little bit of people a little bit excited, then they realize, not such a big deal. So here we are again. But, that's what happens. It's like Santa Claus, right? It's like every few months Santa Claus comes and distributes, it's not that they have to give you anything new. It's that they're constantly giving. You don't realize this. It's the QE program is $60 billion a month they're putting into the bond market. And that also is basically the same as putting into the stock market. It's just more money flows into the bond market and shoves into the economy and creates this sort of, it's going to create inflation. Obviously, if you put more money into the economy, something's going to rise in price. They're creating the money out of nowhere. So when you put $60 billion brand new dollars into the economy, something is going to rise in price. And in this case, it's always stocks. Nothing else is rising. Homes really aren't rising that much. Commodities aren't rising that much. Food's not rising that much. Cars aren't really going up that much. It's freaking stocks. All the money goes into the market. It's unbelievable. I talked about that when I was on the NASDAQ show a couple of weeks ago. They said, well, when's the rally going to end? I'm like, it's only going to end when the Fed stops putting money in. When all the central banks stop putting money in. Because they're putting in relentless, gigantic amounts of money. And what we're doing is nothing. The Bank of Japan and the ECB are putting in, well, no, I take that back. It is a lot. So you think $60 billion is not a lot. It is. It's $720 billion a year. The ECB and the Bank of Japan are putting in about the same amount between them. It's gigantic amounts of money. Just and so put to work in the global market. So, that's a lot of the reasons the market's up. And it goes and money flows into these ETFs, and the ETFs just buy everything. They don't care what it is. They don't care what the price is. They don't look at the value. They just keep, if it's in the index, they buy it. But there's no intelligence to this market. And at some point, people are going to want to sell. And if they want to sell, and there's no, now, it's okay at small volume levels. You're going to always get the buying is enough to support the market. But when people actually want to sell in any kind of volume, that's why every time you get a big volume day, it's usually a down day. It's just because any kind of volume overwhelms the amount of set buying from the ETFs and the funds and so on and so forth. And once you overwhelm the set buying, there's nobody else there. That's why the volume's so thin generally. In fact, take a look at SPY. SPY is look, it doesn't matter what you use to track volume as long as you use the same thing consistently. So we use SPY just because it's easy to look up on Yahoo. And just go to historical data. There you go. And look at these. Whoa. Okay. Look at the volumes this week. Last week, 70, 50, 60, 95, 95, 46, 42, 18. That's not a whole day, but Jesus Christ. We traded less in these 2 days than we did on Friday. So how do you call that a rally? And it's not even a rally anyway. We're not going anywhere. Look at this. Look at this computerized post: 249.19, 249.72, 249.97, 249.83. There's basically no actual movement at all. Doesn't matter what it does intraday. You end up at the same exact place, which is not 250. So you have to realize that these indexes, there's quirks of the indexes, and they can do different things. So, whether the S&P is at 2495 or 2505, it's the same thing. It's all around the 2500 line. You can't, I know TA people do, but you can't take that as like a gospel of anything actually happening. It has to make a significant move one way or another above or below a line, not just a few points. That doesn't prove anything. So, we're not seeing a real breakout yet. All right, but this is the area, if we're going to get a breakout, this is where we have to get a breakout. All these indexes have to pop where they are now. Part of that's up to the Fed, who's coming up in the half hour, and, more so what their outlook is going to be. But, at a certain point, they're doing more harm than good by not raising rates. And that's, I think we're long past that, frankly. And it's going to be hard with the markets at an all-time high. It's very hard to argue that the hurricanes have made them more cautious. But that's the narrative on which we're rallying, is that the hurricanes have put the Fed on hold, therefore the markets rally because there's more free money coming. But that doesn't make any sense, because the thing the Fed's worried about is how the markets will react if they tighten. And they've already said they think the markets are too hot. They said that 5% ago that the markets are too hot, and we went up another 5% since. It's like when Greenspan said we were irrationally exuberant. The The market went way up after he said that. He was right, but not at that time. And the Fed has been saying that already. They want you to prepare for a correction, but nobody's actually preparing for a correction. They're just playing as if this is going to last forever. The oil cycle is supposed to turn down on the 29th. Yeah, it's behaving very strangely. My guy said 54. Why did he say 54 too? Don't know. The oil cycle, my guy said 54. I don't get the connection. Oh, I see, $54. I'm trying to figure out what 54. You know what? I so much don't think oil's going to go to 54 that it didn't even occur to me that you meant the price of oil. There's no way. It's ridiculous. Again, it goes back to that on the petroleum status report we're looking at. Let's take a look at that. So we don't have to go to oil all the time. Futures, energy, oil. Last summer, 1 year ago, basically, September. Last year we were at 44. Now we're at 50. That's 51. I mean, it's $6-7 higher. So you're getting close. It's over 15% higher than where we were last year for no reason. You look at the storage levels we just did. We're using less total product. We have more in storage, or as much in storage as we had before, and that's after a big disruption from the hurricane and after a massive OPEC cut. Neither of those things are helping. They haven't changed the fundamentals from last summer. So this makes basically no sense. And so I'm in the contract for October. Now, this would be nasty. This does go back. This is probably what your guy's looking at. He's looking at this cycle coming back again. I'm saying this is my goal here. I'd like to get back to 44. As I said, though, I'm going to be thrilled to get to 48 because I'm going to make $25,000. So I'm looking at a move back towards the lows in the fall. Whether it's today, tomorrow, or not, but my point is I'm short now, and if it goes up to here, I'm going to be even shorter, and if it goes up to here, I'm going to be even shorter, and eventually, I hope I will get my money. Now, maybe the same fall, if I end up like with 20 contracts here, and I get even a fall, at that point, if I get a fall to 48, I'm going to make $50,000. So, I don't mind having more. I don't mind losing $20,000 if I eventually make $50,000. The question is, will it ever turn? And it certainly is annoying while it's happening. It's not something pleasant. I'm not saying I enjoy this. I'm just, it's very frustrating actually. I thought this would be an easy win this week. That's why I'm frustrated. I didn't think this was going to be a problem, and it's turning out to be a tremendous problem. And I don't understand it. I don't see how. I don't see how you can sustain this kind of price when there's no evidence that there's any demand. And don't forget, all this crap was based on the OPEC cut. In June, this is when OPEC started cutting. All this rally, such as it was because they cut back their oil production. And everybody's all gung-ho, it's going to do this and that and that. Turned out to be a big nothing, and we've trailed off since. And now they're talking about extending, not increasing the cut, extending the cut. That had no effect for a year. So the trading is simply stupid. But what can you do? I mean, you got to grin and bear it. If it's going to be, if the market's going to be rational, you could try to play along. But for me, I prefer to be the rational guy and to say, okay, I'll wait until everyone comes to their senses. As the dollar, speaking of coming to their senses, dollar is right at my buy point. It's still at 91.51. I really think this should be a bottom. Let's take a look at a longer chart of the dollar. Now, obviously 90 is a better line than 91.51, but I just think that because of the other currencies, because of the euro at 120 and the yen at 90 and the pound, well, they're actually fairly low. But they don't. None of these guys want to have their currency any stronger. Neither does China. They don't want strong euro. They don't want that because, Europe needs their manufacturing output. They need to export. Everybody needs to export, of course. Except us, we're a consumer society. See, that's the thing. The logic Trump should employ as far as NAFTA and everything else is like, hey, we are the world's greatest consumers. We consume more than any two groups, any two countries can take the same 300 million people, and you can't put together any group of people who consumes anything like America. We are incredible at consuming stuff. That's our special talent. You can't get Europeans to shop the way we shop. You can't get them to eat the way we eat. You can't get the Japanese people. You can't get Chinese people. Nobody consumes like we do. And it's an asset. It's something you can market to the rest of the world. It's something that we should benefit from. And that's where you have to if you want to balance out trade, you have to play the strength and say, what's that strength? We buy a lot of stuff. And we consume a lot of stuff. So if you want us to be your market, then you pay a toll to come in. That's the tariff. The tariff shouldn't be based on trading goods and so on and so forth. It should be based on hey, if you want to market to the American consumer, pay a tax. And that tax should be in the form of something like a VAT. And other countries do it. We do it in Europe. If we send stuff to Europe, there's a VAT tax. That's where the big discrepancy is. So if you want to raise revenues and utilize the base of what we do, it's like, hey, if you're selling things to U.S. consumers, you pay a tax. End of story. Well, now, what's going to happen if companies say, oh, well, in that case, we won't sell to your consumers? Be like, okay, well, they will have to make it here. That's how you change the economy. If they were serious in any way about fixing things, that's how you fix something in 5 minutes. It's not hard. Yeah, 25 minutes. Do you think there's a fraud at UBID? No. I don't want to say no. I think there's not enough evidence, and it's a complicated issue. The charge is incredibly vague, for one thing. He's basically, I guess any charge is vague because who has access to the books like that? And these guys are not the most reputable firm as far as, they'll come out and tell you they have things about guys they're shorting to knock the price down. For some reason, this is legal. I'm not sure how that works. But I don't think you can possibly know from the evidence. They're basically saying that that UBEN is that they're too good, that their numbers are too good, and it doesn't make sense because they're doing better than their competitors on this, that, and that matrix, and it doesn't make sense because if you look, because if you look at the rest of their peers, nobody can do that except them. Now, it's interesting to me that that's the whole investing premise in Tesla, is that you're going to believe that this one car company is going to make 20% margin selling cars when every other car company in the world ever in 100-year history has only made 5%. So Tesla, though, is going to make 20%, and that's the entire investing premise behind their price. So given that people accept that and reject the fact that UBNT is doing well is beyond me. How is Tesla today? I wanted to short them, but they went down too quick. Yeah, see, that's my shorting spot. It's 385. I called that for ages. And last time it was at 385, we shorted it too. But I wanted to, but then it spiked down really fast. How can we keep it a daily? Oh, because I'm not signed in. That's what. Okay. This is Jackie's. My daughter uses this computer, so I can't keep switching it out for her. All right, so the UBNT, how are they doing? Wow. So now, I don't know why they gapped up here, and all they really did was fill the gap in the end. but they're still in a pretty bullish posture. If you look at the long term, they're just consolidating up on the 200-day moving average. So apparently, there's not really a mass exodus going on here. But now, the thing with the CEO is like, he got on and said, "Oh, this is bullshit," and blah blah blah. Let's see if there's anything about him today. See if there's back and forth. But I think it's just an outside attack. And frankly, you've seen that with Apple today also. So we're going to look at that too. So, this is saying what today? Wow, what is this? How is this news on Ubiquity? This is weird. Why would crude oil signaling breakout? I get, excuse me, I guess a lot of articles are talking about them. I guess they get mentioned a lot in articles, even though it's not actually about them. Now, this is crazy. I've never seen so many irrelevant articles. I haven't seen one article yet actually about them. Anyway, so, the bottom line is that there's not enough information to say anything. They seem like a decent company. I said that yesterday when we were talking chat. I'm like, I don't know. I mean, it seems like, look, there's money. Their revenue goes up. They're making money on their money. They're spending money on R&D. Now, essentially, the short sellers are saying, they're basically saying, well, this is too good. This is too good. And therefore, they're evil. I don't know. It's hard to say. I don't know if you say that about Apple also. Apple's too good. They're evil. I think the best thing about it, though, is if they come out the other end of this, and these are really their numbers, then they're a definite buy. So put it that way. So I would not go gung-ho crazy on them, but frankly, I don't know what the price of the contract is. Let's take a look. It's not a slam dunk because you can't put your finger on what's wrong, as you can tell from my narrative right now. You can't, if there was one thing you point to, like Lumber Liquidators, okay, for example, we went gung-ho bullish on Lumber Liquidators when they sold off because they were being attacked. Also, same kind of thing, where the short sellers conducted their own tests and declared that Lumber Liquidators is poisoning people with cyanide or whatever in the wood. And it turns out that obviously all wood contains cyanide. This is what they do. They figure something out that's a premise, and they look for a victim. So it's like, well, some guy probably was sitting there one day and said, hey, did you know there's cyanide in wood? And they're like, really? Cyanide in wood? Hey, let's see if we can figure out a way to make a scare of cyanide in wood that makes us money. And then they go look for a victim. That's what they did with Lumber Liquidators, essentially. They basically, like, all wood has cyanide. And so these guys sell wood flooring, obviously has cyanide. There are acceptable levels. And their wood is generally in the acceptable levels. Some of the wood from China was a little bit pushing the limit, but still turned out to be acceptable. It was still in the bounds of acceptable levels. But if you have a shady, if you hire some shady testers who bend the test to show certain things, you can show quotes, in quotes, legitimate results, because that's what they do. They say, oh, we paid to have a study, just like Exxon pays to have a study that says that climate change isn't, the man-made climate change is not a thing. These guys pay to have a study done, and the study goes their way. And frankly, they could have paid to have 40 studies done, and they only show you the one that they paid for that did it. That's another trick people use. You can always get aberrant results from a study, and these guys know this, so they'll commission dozens of studies from dozens of different testing people, each of which have a reputation of some sort, and what they're counting on is the variance in test results, and that if you do enough testing, you're bound to get one result that's off the chart. Now, a scientist would throw the one result away. What they do is they throw away every other result, and they're not obligated to talk about it. They go to the press with the one lab that they have. So you won't be able to catch them emailing back and forth. There's no secret conversations with the scientists where they say, oh, we want you to show as much cyanide as possible. That's not the way it works. What they do is they just get as many studies as possible, and we find the one or two that aren't in the norm. So this is how you too. If you want to become an evil short seller, you can do these things too. Now, obviously, you need the money to commission the studies and do all the things. But you find out ways that something is doing something that people are going to get upset about, and you attack the company for it. Like self-driving cars killing people is a good one. It's like you'll be able to do they'll be able to go after all these companies making self-driving cars. To me, it's like the biggest gamble, unless they can get the regulators to say, look, people die. This is the conversation we're going to have self-driving cars. People die in accidents. Just because the car kills somebody doesn't mean you get to sue the manufacturer every time. It'd be like going to sue the parents because their kid killed somebody in a car. It's like, well, you made him. It's like you make a kid, you do the best you can, and you send them out in the world. That's what these guys are doing with the cars. They have to make a car. Now, you could be negligent, and that's wrong, obviously. You're negligent if you don't pay attention to safety, like Tesla's doing. That's, by the way, speaking of short, there was a great article on how Tesla, every other car company doing self-driving cars is using radar, basically, or some type of radar for the car to get a picture of the environment. Tesla is using cameras because cameras are much cheaper than radar systems. Cameras are cameras, and robots don't have eyes. You know what I mean? The computer doesn't have eyes and doesn't think about the world in terms of like the way we look at things. It's actually much more complicated and much fuzzier for a computer to get an image of the surroundings and then have to interpret the image to figure out what's going on around it, as opposed to a radar picture that essentially shows all of the solid objects around the car and gives the car a very clean picture of all the solid objects that are, and not only all the solid objects, but how fast they're moving and which way they're moving and the direction and so on and so forth. So that's how all self-driving cars do that. They are constantly pinging their environment to see where everything is and constantly getting a feedback of where things are and how they're moving. It's incredible. They've had millions of hours of testing already in Uber and whoever they were working with. They've already done millions of hours of driving in self-driving cars, and what they've done is the way Uber does it is they have a self-driving car. There's always a driver sitting in the self-driving car, but by doing this, they're collecting incredible amounts of data. How are we on this topic from you? Anyway, but that's not what Tesla's doing. Okay, Tesla's doing something completely ridiculous, and a lot of people say it's never going to work. What they're doing is never going to work, and Musk keeps saying, "Oh, the next upgrade will do this and that." There's already reports of Tesla doing stupid things, and they do stupid things because a shadow fools it. That stuff like that. A bright light fools it. A shadow fools it. That's no good. The lens getting dirty fools it. You can't even leave yourself open to things like that. That's a ridiculous way to set something up. Rain, forget it. It starts raining and you can't barely can use the thing. So anyway, but point being, so there's negligence like possibly Tesla's engaged in, where you're clearly using inferior technology, and there's just you make the car as best you possibly can, and if it hits somebody in a non, obviously if the Ford Fiesta hits, if every Ford Fiesta just hits people right out of the showroom, then there's something wrong with the Ford Fiesta. But if the Ford Fiesta hits one person every 100 million miles driven, that's just normal. That's just life. And until they recognize that and pass laws that reflect that to protect the auto manufacturers, this is going to be a really tricky sort of thing getting into the self-driving car stuff. Anyway, so back to the ubiquity. Are they committing a fraud? Are they cooking their books? It doesn't look like it. I think they got pretty steady general sales. I think it's probably very overblown. But, I was going to get back to that. So now that we said that, Apple. it's a normal cycle where the short sellers start attacking. And in Apple's case, they're being attacked because they've got a new phone coming out. And so immediately, everybody's pulling every negative thing they can. Everybody, all the people who want Apple to go down, which are probably people who want to buy them, frankly. But they want to buy them at a lower price. How do you get to a lower price? You have to find something wrong. So they're picking any little bit of any little thing that's not going right. And look, Apple Cash won't be a Vimo killer. Anyway, so today they were talking about the iPhone sales of the 8. Now, of course, the 8 is going to have not as good a sales as the 7 did because they got a 10. I'm not buying the 8 because they got a 10. I can't even understand why they did this. It's a weird thing. It's like I understand it's like the luxury model, but most people who are buying an iPhone 7 Plus or something like that for $900 aren't squeamish about buying the 10 for $1,000. In fact, I remember when I went to buy my 7 originally, and I went to the store, and the AT&T people were like, they're like, you can get the lower price. We're sold out of the top models with the most memory. What we have left of the models with like 32 gigabytes instead of 64, whatever it was. And so nobody was balking at paying extra for more memory then. People didn't say, "Oh my God, $700 for a phone. Get me the one with the least amount of memory, please." No, nobody was saying that. Everybody was buying the best one. Not everybody, but you know what I mean. So, it's not like Apple is blowing their market with the price. I think I've never heard a sillier sort of knock on the company than that. What's going on is because they announced all this stuff that's better than what they've got, and the headphones too. It's a weird thing like that. Now they've got the wireless charging headphones. Like, well, why would I want? I said to the Apple guy this morning, like, why do I want the regular headphones if you're coming out with the wireless charging headphones, earbuds, whatever they call them, AirPods? Why would I want to buy this until you have the wireless charging case now? And what and what am I going to do with all this stuff? So everybody's taking. So you see all these little knocks on Apple. Are they finding anything? So here you go. Analyst report indicates weak iPhone 8 demand. It's not even shipping yet, but there's weak demand. I love these articles. It's so funny. But again, look, if you're a buyer, if you're a fundamental buyer, you got to look at things like this and think about what are they really saying? So demand
we had a good idea over what the price would be. We did not know that we'd.
So pre-order volumes for the 8 were below the 7 and 6 because people are waiting. Customers ordered 1.5 million handsets on Chinese retail site in the first 3 days compared with 3.5 million comparable for 7 orders. Stock fell 3.1%. And the other thing is also, though, this was the first time an iPhone was available in China. This is not the first time. And these guys all got their phones, and recently. So that's a terrible comp because that was the first time a massive order was able to be made in China. This time around, these guys only just bought their phones, not even 2 years ago. And they're already sending them a new phone. So I'm sure less people want the new phone. That's it. That's all they say. That's their whole premise is that there's less phones ordered in China. Meanwhile, Apple doesn't have enough. Oh, and by the way, the knock on Apple before the announcement was they couldn't possibly deliver enough phones to meet the demand. So the reason to sell Apple before was they couldn't make enough phones to meet the demand. Now the reason that they sell Apple is because the demand is in line with how many phones they're making. Because Apple accurately forecast how many phones would be required, and they moved the models to have to have 3 models instead of the 2 models. And so that's what you get though. There's always people with motivations planting articles, and it's really sad because it used to be that this kind of stuff wouldn't spill over into Bloomberg and whatever, but these days it doesn't work like that anymore. It's like anybody. There's so many reporters who are stringers, and they just, you never know. It's not like a steady amount of guys. it used to be the New York Times had like 100 reporters. And those 100 reporters were New York Times reporters, and they only wrote for the Times, and they all answered to their editors and so on and so forth. And that was it. And you would read these things, you would know the guys because you read the articles, and you would say, oh, I know that guy, I know what he thinks about this, and I know what he thinks about that, so when he tells me something, I know what he's talking about. That's not the way the news works anymore. Now it's sort of supplied here and supplied there, and Bloomberg will have like 500 people, and they'll print like 200 articles a day, which is more than anybody's ever going to read. But it's all about volume and clicks and having, the key is they want to have, and I talk to these magazines and stuff because they want, they want me ask me to write for them and stuff. They want to cover as many ticker symbols as possible in a day. They encourage the writers to write about a lot of different stuff. And they don't say to you, what are you an expert in? They never ask that. They never say, say what field are you in? But they won't say, do you know do you follow any specific stock? No, they care less. I haven't been asked about if I follow a specific stock in years. They're like, what sectors do you like? We want you to write this whole sector and try to have a big variety. Try to get lots of symbols in every month. Like, why? Why would I do that? In the old days, you used to have a guy who would only write about 3 companies. And he followed them closely and was an expert. They don't care if you're an expert anymore. They just want an article. And you get all these articles that say the same thing over and over and over again. It's really annoying. Because they have nothing to add. These people have nothing to add. They have nothing new to say. They're all reporting on what the last guy said. And unfortunately, that is the state of the market these days. So you have to just take all this stuff with a grain of salt. You have to realize, like, there's motivations behind what these people are writing, and there's motivations behind the studies that they're citing. There's they're being fed this stuff. That's the other thing. They're constantly, PR firms spin out and feed all these reporters articles. And since the reporters are being pressured to find things to say about all these different companies, they just read these PR reports and take them as gospel and essentially regurgitate to you a PR report from the company. And by the way, a PR report can be this. Now, there is a glitch in the new Apple Watch. You know what the glitch is?
It's not exactly a tethering issue, Melissa. It's really a confusion issue when it comes to the watch and wireless. The watch.
Come on. They only have text. The new watch, when it's roaming in wireless, will sometimes fail to connect. If it picks up too many bad connections, it'll not connect. It'll stop connecting or stop trying to connect to a network. So in other words, if it's in an area where it gets a lot of bad connections, it can require, you have to reboot it basically to get it to log into a good connection. It's a glitch. Apple said it's a glitch, and they're going to fix it, and they're going to give you an update on the operating system. It's not even a thing. It's not a big deal. It's like a normal 1.0 version of something problem. But, that's they try to make a big deal about everything. And again, I'm not defending Apple. Frankly, we're short Apple. Where's that portfolio? Do we have here we are. Where's our Apple? What is this? This is the options opportunity portfolio. We have that hasn't been fixed yet. Whatever amount, we roll these 40 short calls to some other short calls, though. We have a generally short front month position on Apple because we expect it to sell off at this point. The only time they're going to go back up between now is next earnings. Next earnings, when they report strong earnings, then it's going to go back up again. But there's nothing, there's nothing to indicate anything more than just it's still an iPhone. All the same problems that they used to say about the iPhone are going to be able to say now. That Apple is basically still, they're not really, but look like a one-trick pony because the iPhone sales completely dominate the company. There's nothing that they did at this last meeting that changes that. All they did is put out another iPhone. That doesn't change their core problem is that the iPhone is too much of their business. And so the best way to attack them, though, is now there's an opening since they have a new phone and it's not in people's hands, so the people can't dispute anything these people are saying in their studies. Because I remember last time when the iPhone 6 and 7s came out, they used to say, "Oh, there's no demand and this and that." And meanwhile, I'm looking at my kids and their friends at a party, and they're all talking on their phones. I'm like, I'm counting like 20 kids, and there's 18 iPhones out of 20 kids. I'm like, what is this about no demand? It's like, the kids are totally buying iPhones. I don't think it's even like I think the ones who don't have iPhones are generally embarrassed if they don't have iPhones. And I know a lot of people. I know people say, "Oh, my Galaxy's better," and blah blah blah. But it's the texting. That's what it is. It's all about the texting for the kids and the high school kids. I mean, and the younger ones. And the Apple texting is still apparently head and shoulders above. So when and the camera quality too. That's the other thing. Apple knows their market. Apple focuses on the emojis. Remember the 3D emojis from the demonstration? They're focused on emojis and texting tools and taking better pictures because that's what the kids use their phones for. They really don't give a crap about much of anything else. They care about that. They don't talk on the phone. They text to each other, and they and I tell my kids all the time, stop, don't text me. It's like so annoying. Pick up the phone, call me. But they try to just attack Apple on whatever they think is vulnerable. So right now, until the phone's actually out and gets real reviews and people are using them, they can talk it down. So I'm expecting a fall. I definitely expect a fall to here. This is where our shorts are, about 155 and 145. So here. And 145 is the 200-day. It's not yet, but by the time this gets down to it, it'll be the 200-day moving average where we'll have support and we'll be done bullish again on Apple. But right now, they were right for a correction, so we're having a little bit of a correction. So you got to be aware of those cycles in the market. That's what happens. Oh, the Fed, damn it. Ooh, right on time. All right, shush. All right, hang on. You got to listen to this. "17 seconds. Wow, that was good timing. How we doing? Chart. Damn it, on the move again. Here it is. Unchanged. Whoa. Okay. This is a big deal. They're going to reduce their balance sheet up to $600 billion a year, which is exactly what I said yesterday, isn't it? They've reduced their long-term outlook for rates to 2.75%. All right. They're using the hurricane for an excuse. Holy cow, they said a lot of stuff. What is this? This is their statement? It was a PD. Wait, what the hell? Doesn't look like it used to. Okay. They just changed the format. All right. Wow. What a lot of, that's huge changes. All right. Let's take a look at this. Information received, blah, blah, blah. Overall inflation measures, excluding food and energy, have declined. Yeah, because who eats food or uses energy? Inflation compensation have been low. So good news, wages are low, and we're not going to count food and energy, so we're going to call inflation low too, and everybody's happy. Consistent with statutory mandate, committee continues to expect with gradual adjustments. Okay, higher prices for gasoline and other items in the aftermath of the hurricanes will likely boost inflation temporarily. Apart from that effect, inflation in the 12-month basis is expected to remain somewhat below 2%. So they're counting on, keep this in mind going forward, they're counting on fuel prices normalizing. Hurricanes, blah, 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 have devastated many communities, inflicting hardships, storm-related disruptions, and rebuilding will affect economic activity. but past experience suggests that the storms are unlikely to materially alter the course of the economy over the medium term. Consequently, the committee continues to expect that with gradual adjustments in the stance of monetary policy, economic activity will expand at a moderate rate, and labor market conditions will strengthen somewhat further. Higher prices, wow, strengthen further. How much lower can unemployment go? Higher prices on gasoline in the hurricane and boost inflation, we talked about that. Near-term risks to the outlook appear balanced, but the committee is monitoring inflation development. They're worried about higher inflation still, but they're still not raising rates. In the view of realized expected, they're leading the rates at 1 to 1.25%. Obviously, they consider that accommodative, thereby supporting further strengthening labor market conditions, sustained return to 2% inflation. In determining the size of future adjustments, the arranging federal committee will employ blah, 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 2%. Okay. Assessments will take into account. Where's the thing? Wait a minute. There's an addendum. In October, the committee will initiate the balance sheet normalization program described in the June addendum. Okay. That was from June. I don't know if they have that here. Hang on a second. That's okay. I know what it was generally. June. Addendum to the policy normalization. Yay. All right. That's not what I heard. Gradually. All right. They're going to gradually reduce the securities holdings according to, so there's no surprise. The bottom line is this is not a surprise. This is from June that they said that. So they left rates unchanged, which is what everyone expected they would do. They're going to start withdrawing stimulus. So again, the free money is getting cut off. So they're going to, the Federal Reserve receives from maturing treasury. The committee anticipates a cap of $6 billion a month initially and will increase in $6 billion at 3-month intervals. So every 3 months, they're going to take another $6 billion of their $60 billion monthly. They're currently doing $60 billion a month. They're going to reduce that by 10% per quarter until it's $30 billion. So 5 quarters of that. For payments of principal the Fed receives in quarters, blah, blah, blah. Oh, and they're counting this as a separate item. That'll be $4 billion. So the total is $10 billion a quarter. Of the $60 billion total they're putting in, they're going to take away $10 billion a quarter for 5 quarters. So they're going to leave $10 billion a month of stimulus out of $60 billion now. They're going to withdraw $50 billion a month, $600 billion a year of stimulus. Now, what does that mean? That means, first of all, they're going to buy $600 billion less bonds. This is where it all hits the fan. But as the bonds they have are available for sale, they're going to cash them in to reduce their balance sheet, and their bonds roll over pretty frequently. So they're going to be reducing essentially $600 billion a month off their balance sheet. Now, where's that money going to come from? It's going to come out of our economy. And our economy is $18.5 trillion. And that sounds like a lot, but $600 billion is a lot too. And then, by the way, and again, this is the math I did yesterday. 18,500 billion is 18 trillion divided by 600. Oh, I did that wrong. That was third. 600 divided by 18.5. Yeah, 3.2. It's 3.2% of our entire GDP. That's the reversal. That's a big reversal. That is not a little reversal. And that's going to go on for 5 years to get their balance sheet in line with that pace. So, what did I say yesterday? I said exactly what I said yesterday. What did I say yesterday? I swear I said the exact thing. Let me see. Blah, blah, blah. Oh, this was a good article on machine learning. I like that article. I love reading Phil Stockwell. All right, where are we? Such good stuff. All right. Yeah. Yeah, we should still have magazines. I'd like to publish a magazine. There's such pride in our stuff. It's like, it'd be nice to, like, have it bound up. Oh, yeah, here we go. No, I wasn't talking too much about that. Okay. Oh, yeah. Even if the Fed only withdraws their money over the same 8 years they put it in, that's $500 billion a year coming out. I was off by $100 billion coming out of the economy, significantly lower the GDP, and it won't be just our Fed though. It's going to be the Bank of England and the Bank of Japan and the ECB, and everybody's going to start unwinding all this money they put into the economy. And meanwhile, the economy wouldn't be growing at 3% if they weren't putting 3% in every year. So every freaking projection that you're reading and everything going forward is all bullshit. I just want you to keep that in mind. It's completely, all these projections that you see going forward are bullshit. It cannot actually do what they say it's going to do. We can't ignore this kind of withdrawal of cash from the economy. And boom, the markets are coming. No, except for the Russell, of course. The markets are coming down except the Russell. So what do? You short the laggard. So the Russell at 1445, TF 1445. That's the short to play right now. Okay, there's not much of a sell-off though. I mean, it's just unbelievable how resilient the market is generally. But I think as people digest this and start understanding the incredible size of the withdrawal, now they're ramping up slowly. It's going to take them 5 quarters. So starting now until the end of next year, the impact will be muted. So next year they'll take out 1.5%, 2.5% of the economy. But that's the reason they have this chart. So it's not going to be 3% right away. But I pointed this out yesterday. Look at what the Fed's projecting. They project 1.9 to 2.6% this year. Then next year, 1.6 to 2.4. That's lower. And then the year after that, 1.8 to 2.7. They're barely going to get back to this year in the long run. Yes. Now, and keep this in mind, Donald Trump's tax plans are based on 3 to 4% growth. And if he's wrong about the 3 to 4% growth, then we're going to go about $1 trillion more into debt every year, more than he's projecting, which is still $1 trillion. We can end up going $2 trillion a year into debt, like Japan. Japan goes 10% of their GDP into debt every year. That's what we're going to start doing, as opposed to the 5% of our GDP we go in now. So we can amp it up to 2%. This is crazy, guys. I got to tell you, it's really, it's crazy that the markets are this high. It really is. There's just absolutely no way you could reconcile this with the going forward economy. Ooh, Nikkei, the dollar, yay! I make money on my dollar. Ha ha! I forgot about that one. Did we talk about that in the beginning? I said in the morning that I was going long on the dollar. Anyway, so right from 91.50, let's see if that's active trader. Dollar. Okay. I don't care about you, oil. You're just annoying. Yeah. So just missed taking 1,000 off the table at 92. So that's good news. I got one bright spot in my day. My dollar trade worked out. That was easy money, right? And now we'll wait for everything else. I'm very, very confident that we're going to reconcile lower now because that was just crazy. And wow, but there's no way you can spin this as a positive. I mean, they're immediately going to start withdrawing stimulus. It's going to be less stimulus, and they're going to take it back. All right, so in other words, here's the difference, okay? Your boss is going to say to you, let's say you get $1,000 a week, okay? Your boss say, Well, I've been giving you 1,000 a week, and I'm going to stop giving you 1,000 a week. And I'm going to have to start taking it back to go back. So since you've gotten 500 a week, since you're getting 500 a week, I've added 500 a week. But now I need that back. So what I'm going to start doing is I'm going to only pay you next quarter. I'm going to pay you $450 a week. But I'm also going to need $50 from you. So your net goes down 10%. His net, it's not just his cut of 10%. Your net goes down, 10% of your entire check. He's taking 20% of his difference off the table. You're taking 10% of your whole. I'm sorry. He's taking 10% of his stimulus off the table, but you have to. But because he's taking it off and not giving it to you anymore, and you have to give it back, you're giving double what he's taking. So it's actually worse for you now to give it in this cycle than it was on the way up. Because you're no longer getting it and you're giving it back. That's the economy going forward. If the Fed has the balls to stick to it, it doesn't mean they're going to stick to their guns. They're basically trying to hedge by saying, well, if we don't see inflation and if the wages aren't down and so on and so forth, 4% unemployment is basically full employment. I think 3.5% is theoretically as low as it can get. Once you hit 3.5%, at any given time, people are between jobs. They're transitioning. People do get fired. People get fired, people get hired, people switch jobs, so on and so forth. So there's a certain base level of unemployment where 3.5% is fairly normal for people to be between jobs. Given any group of 100 people, that's how many people are going to be between jobs at any given time. It's crazy to try to push anything lower than that. The Fed knows that. In fact, you actually start getting wage pressures. When you get to these levels of unemployment, it's hard for people to hire people. They have to spend more money to hire people, then they get wage inflation. The Fed completely freaks. Now, should there be wage inflation, the Fed will freak out and raise rates much faster than you think. So we got to watch out for that too. But anyway, none of this is going to happen instantly. Like I said last time, you have the Fed meeting, people take it, and they go, and the market goes up or it drifts sideways. But then in a couple of weeks or in a week, they digest it, and boom, and we're going to see, and we're going to see some, I think, some significant selling. So we'll see what happens. But this is nothing here was good. All right. Is UBED worth the short? No, it's not. I don't think it's worth the short. I think, frankly, I've been speculating long. But it doesn't have long, like I said, it doesn't have really long enough options where I'd want to gamble on it too much. But I think it's going to be, I think, frankly, it's a wash over them. Why the huge push for free trade? Well, for me, I think free trade is good. I'm not sure in what context. We can't take advantage of slave labor everywhere. So I think that there are 40 million slaves in the world currently. Currently, 40 million people are slaves. That's a lot of slaves. Actual slaves, like slaves. I don't remember where. I mean, obviously, there's Africa, Asia, things like that. What happened to LB today? It's going up now, it's down 5. Again, attacks. All right, sorry, we're still on that topic, so I want to get back to that. That's a good one. Another one being attacked. LB. Bra pricing concerns. We all have bra pricing concerns. So this has nothing to do with the facts. The facts of why LB sales are down is not because they're losing sales in bras. It's because they discontinued swimwear. And they discontinued another apparel segment that they basically cut 2 segments of their market, and the sales of bras and such have actually made up for it. But on the whole, their comp store sales are down like 5% because they cut what was like 10% of their sales out of the store because they weren't making it was less profitable. They concentrate on more profitable things like bras. See Exhibit A, Exhibit B, Exhibit C, D, and E. All right. And don't forget panties. All right. So bras and panties are where we focus, everybody. You all focus on bras and panties? Good. All right. So people, it was the funniest thing because I love these analysts. So Cowen goes. Cowen was bullish on LB, and now they come. So now that it's down, they have to come up with an excuse for why they're taking off their overweight rating. They had an overweight rating all year long, and now they're taking off their overweight rating. Why? Because they look like idiots. At some point, LB, if you have an overweight rating on a stock at the beginning of the year, when it's at 62 or 65, and now it's at 37, and you still have an overweight rating on it, people are like, what the hell is wrong with you people? So they have to change their rating. And that way, anybody who looks at it tomorrow sees, oh, Cowen says neutral. It's like, because they don't want to say overweight anymore. They said that all year. They have to show that they're on top of the game. So they changed their call from outperform to market perform. It's still market perform, but it's no longer outperform. And they say blah 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 blah. Okay, they need all right. We seek risk to comp and margin if L Brands does not achieve. So he's not even there's no actual information here other than his thoughts on it. So we hope they can stimulate demand to drive store traffic and gain lingerie and sport. However, we see a risk to comp margins if L Brand does not achieve elevated pricing. Oliver Chen wrote to his clients. Why did we lose 50% on LB this year? Well, here's why. Victoria's Secret needs to rebalance their core lingerie and offer a shift. LB is the owner of Victoria. Okay, we know that. Blah, 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 blah. Chen said Victoria's Secret is losing market share to competitors. Like American Eagle. Again, I have two daughters. They're 16 and 17. They go to Pink, which is the junior Victoria's Secret. They do not go to American Eagle for bras or lingerie or anything of the sort. And neither do any of their friends. I go to the mall with my daughters and their friends. It's like I'm always very interested in what they're doing. Now, I live in a well-off neighborhood, blah, blah, blah. So, but again, that's Victoria's Secret's market. They're not really going after the people in in the middle of West Virginia trying to get them to go to the store. They're in the well-to-do areas, basically. That's where the sweet spot. I was in the store in New York. It was packed. I couldn't believe how packed it was. It was like Christmas. It was crazy. So, yes, American Eagle is doing more, but the question is, it grew 26% of what, and why would that necessarily come out of LB? It's a totally different type of bras. These are functional bras, and yeah, people wear those every day. All right, but on the other hand, my daughters buy leggings and sweatshirts and things at Victoria's Secret. At Pink, not Victoria's Secret, at Pink. And they have all the kids in school. They love this Pink stuff. It's actually well made. Expensive but well made. So what are you gonna do? It's like Lululemon, which is ridiculously expensive but also well made generally. And sports bra, Nike, Under Armour. I mean, it's not that much of a thing. They want to be, they're not looking for functionality. There's always been functional bras and this and that. It's a guy who's totally wrong and is trying to figure out how to explain how he was wrong and what's going on. And notice everything says if this, if that, and this, and then if this doesn't happen, then this guy has no clue. That's why he was long when they were at 62. We weren't long until they were like at 40-something. But it took us, we were way early on the show. Here's where we came in. We came in, right about in the low 40s, I decided I liked them. And they've gone down. They went up for a while, and they went down, and now they're down here. I like them more down here. I don't care. My pricing is still here. I think this is a great price. We're going to get back to 50, but no time soon. It's a turnaround. The reason they've had all year long, they've had bad comps is because they cut lines from their store. So it's hard to have good comps because people, if you stop selling bathing suits, people don't buy more bras to make up for it. They buy the same stuff they usually buy, but because they focused on, what they did is they cut non-profitable things, increased the space they use for the more profitable thing, like hoodies and leggings and things like that make them more money. They increased their actual bottom line. Their bottom line's gone up. Their margins have gone up. And bras is not the only thing they have anymore. That's like a view from like 10 years ago for Victoria's Secret. All right, and not only that, though, Bed Bath & Beyond, holy crap. Is it Bed Bath & Beyond? Or no, it's one of those things. Bath & Body Works. Those places are crazy profitable because they've got these candles cost nothing to make, and they sell them for like $10, $15. I can't believe they charge for candles these days. And people buy them. I mean, especially for gifts. Like it's all the gifting thing. Anyway, so it's just overblown. The reaction is overblown and silly, and I like them down here. In fact, and I think I've said this is probably my stock of the year. You know, unless I uncover something I don't like, this is going to be my stock of the year next year. At this price, God bless them. If they stay down here, and I said I was worried. I said the other day, I said I'm worried that they're going to go too high before November, and I won't be able to make them my stock of the year. At this price, they're definitely my trade of the year for next year. And in fact, I just did that one, didn't I? On what was that show? On Money Talk. I made a portfolio for them, and there's LB right there. And look, the trade is back to even. We were profitable this morning. Now it's down to even. So here's the trade I really like for LB. Well, here's our IMAX. IMAX is still doing good. They're up today. For LB, we have the January 32.50 calls, and they are currently $8. And by the way, try to get better prices. This is your worst case pricing, right, in these things. The January, we buy those. We sell these in 2019. We sell the $40 calls, or they're currently $4.70. So this spread is like $3.30 on a $7.50 spread. But then we're going to take half that many. We're going to sell 20 of the $32.50 puts for $4.75. So if this is $3.30 and this is say $4.80, just to round it up. So if this is $4.80 and this is $3.30, then we're taking half of $4.80, which is $2.40. Off the $3.30, that's $1.10. So your net of the spread is $1.10 per too long. So if it's a $7.50 spread, so for each $15 you can make, it costs you $1.10 in cash on the spread. And all it has to do is get to 40. It's at 37 now. Okay, that's why it's my trade of the year. You make $13.90 if they get back to 40. So let's look at the chart. Okay, you guys are very lucky. I never have a trade of the year this early. Oh, I'm sorry. Last year we were going to make IBM the trade of the year, and it lost out at the last minute to Silver Wheaton. And right around this time of year, I think. And the reason IBM lost out is because it popped up before it was time to call the trade of the year officially. That's the only reason it wasn't IBM was because it started moving too soon. So here we're at the exact point at which you're getting the best possible price for limited brands. Now, what happened to IBM last year? Let's see. So I love that trade. And by the way, this portfolio, my options opportunity people, let's see. Where's my portfolio? This portfolio is called the Money Talk portfolio. We update this on philstockworld.com/moneytalk. We actually update this portfolio. You can find it there. Let's see. So you can see, so we have an Apple trade, an IMAX trade, the LB trade, and the Silver Wheaton trade. Or, I'm sorry, Wheaton Precious Metals as they are now known. So here's what happened last year. Where are we? Oh, so last year, Oh, not last year. I'm sorry. Wait. When was Wheaton Chanel? It was this year, right? Yes. That's right. So when IBM was down here, in fact, IBM was now back to where we were going to make it the trade of the year. IBM was down here this time of year, 140, and I wanted to make it my trade of the year, but we announced the trade of the year at Christmas time, and it was already up to 165, and I didn't want to chase it, which is thankfully a good idea because we did work out that it shouldn't have been chased. But now at 140, I like him again. So I like IBM. I'll tell you a trade on that in a second. And at that same time, WPM. So, whether I like something or not is not as relevant also as whether it's a good time to buy it, if I'm going to make it a trade of the year. Wheaton, at the same time, got cheaper, and that's why we're in the money. Even though it doesn't seem to have had a great year, we started our trade of the year back in the fall, and we liked it back here, and we picked it up and been up and down since. But we don't give a crap as long as it stays above 20. We're happy. This was our trade of the year. So I felt more confident that this would be higher than IBM. And of course, it moves along with silver prices. Now, let's talk about IBM. So there's one I definitely like. We already have IBM. Pretty sure we already have IBM in the LTP in some way. Long-term portfolio. $1 million cash on hand. Now that's good to have, right? IBM. Yeah. This is an old trade. It's actually not that profitable right now, so it's because IBM came back. So you can still do this trade, but from scratch I might do something better. This is we have the 130 calls we partially covered with the 150 calls of 2019, and we sold the 135 puts. Now, actually, you know what? That's probably a good target. Now, that's extremely conservative considering we're at 145, and so we're playing it to go to 150 to make the money on this trade. I'm sure IBM has 2020 by now, so let's take a look at that though, because that could probably get you some better money. IBM. Oh no. IBM. Let's try again. Great. Okay. Yes, 2020. There it is. All right, so we're at 145. Well, actually, 145. So we're at 145, and you can sell the 2020. Let's see what's worth selling. See, I don't see any reason it would be much below where it is now. So I would sell the 135 puts. You're going to get, last sale was 1540. So I figure you're going to get at least 1450 for these minimum. So let's even say 15. So just if you don't get it, wait. Wait until it dips. If it doesn't dip, okay, no biggie. It's always true about. By the way, it's always true with your entering positions. Like especially, think about the mechanics of your position. It's not important to sell the put because if you take a spread like the let's say we go with the 140, which is $16, going by the last sales here. So 140, $16. This is 2020. And let's say we sell these guys for $8. That's 160. So you're going to have a $20 spread, the 140, 160 spread. And that's $8 net. Wait. Is that right? 140. Yeah. Wow. Okay. So a $20 spread is $8. So here's what I mean about the puts. If IBM goes up from here, you're already $5 in the money on your $8 spread. The spread pays $12, 150% profit with no margin at all. Pays 150% profit with no margin at all if you just leave the spread. The 145, the 140, 160 bull call spread in 2020. It's $8. It pays $20. All right? Don't need more than that. But since you can, if you have the margin for it, let's say you do 10 of those for $8,000. Then you could sell 5 of the 135 puts for did I say the 135 puts? Yeah. So 5 of the 135 puts. And I'll show you how that looks. Sell 5 135 puts. Oh, wrong one. For $15. Never accept the prices it tells you, because it's always like they'll get you in the low end of the range. Let's see what the margin is. The margin is only $5,000. You're going to collect $7,500, and the margin is $5,000. So you pick up the spread. So you pick up the 140, 160 spread, 10 of those for $8,000, and you sell 5 of the 135 puts for $7,500. That means your net on the $10,000 spread. I'm sorry, not $10,000. Your net on the $20,000 spread is 10 of the $20 spread, right? So 140, 160. So if it goes well, it pays $20,000. You're spending $8,000 to be in it, and you're collecting $7,500 from the 135 puts against just $5,000 in margin. Your net cash outlay, and there's no margin on the call, so your net cash outlay drops to $500 on the $20,000 spread. And you've got $5,000, whatever it said, in margin on the other side. That's a great trade. Your worst case scenario is owning IBM as only 500 shares of IBM at 135. That's your worst case scenario. But like I said, though, mechanically, don't get caught up in the $500 thing. The cost of the spread is that you're promising to buy 500 shares of IBM for 135 minus 15, 120. And that's your net. So mechanically, you just, once you fill your calls, you spread at $8, you're good, because you're going to make 100. If you never do sell a put, you're going to make 150% on your money. If you do sell a put, you'll make a lot more than that. But that's not really the point. The point is because it's a separate transaction, it's lowering your cash outlay tremendously, obviously, to nothing. But don't not get your price. That's what I'm saying. Why would you not? There's no hurry to fill the put side, because the bull call spread by itself is a perfectly great play. That makes 150%. It turns into a ridiculous, 40 times return on your money, which is what, 3,900% return of $500 if you do sell the put on the put side. It's not mandatory. It's not important whether or not you do that. So don't not get your price. And that's how you have to think of it. Always think about don't be anxious to trade something. Say, well, I can get it later. It's not a big deal. I just want to get a good price for it. And also, by the way, if you wait, even if you wait again, all you have to do is raise a few $1,000s. You don't need, let's say you only end up, 3 months from now, you never got your fill at the lower price, and IBM's at 170 for whatever reason. Let's say IBM goes up to 170 in a few months. So you'll get a lot less money for the puts, but then you can sell the 140 puts for $5. How much are they now? They're 15 now. So, actually 170 is 15 points higher, so we drop 5, 10, 15. It'll still be $10 for the 140 put. It'll be basically it'll be about the price of the 125. So you can still collect $5,000 3 months from now after IBM has gone up 10%, and you'll still have them, and then you'll be in a net $3,000 trade that pays $20,000. How would that be a tragedy? And you'd also be a lot more confident because IBM would have gone up 10%, and your full call spread would be weighing the money. So you can't lose by waiting. And so consider that, but don't rush into filling trades, especially when you don't have to. when there's no consequences, there's no negative, other than missing out on some more gains. That's an interesting one. Here, listen. Oh, I went to a voicemail list. So there's no real consequence other than saying, oh, I wish I had also sold the puts. But there's no negative consequences to your action in not selling the puts at a good price. So when you're filling your positions, make sure you know what you're doing and why you're doing it and how it's affecting your trade. Because a lot of people, I see a lot of people get bad fills on their trades, and it's mostly because you're rushing. Like if you look at the portfolios, we fill things, I put out the prices, and almost any time I'm going to bid, I'm going to bid less on each leg. The way I started positions, I'll bid a little bit less on each leg of the trade. So I bid on the low end. So in other words, the spread on the 140s is ridiculous. It's 16.75 to 21. And the last spread was 18.50. So right in the middle of it, basically, 18.50 was last thing. I might bid 18 on this and see if anyone wants it. Now, you got to be realistic. If IBM's like going up and up and up, you're not going to get it. But I'll bid, if I can, I'll bid like 18 and see if I get a bite. Is this any games I want to play that? Nope. Who that is? I have two lines that don't ring, but this line rings, unfortunately. And then the 160 put is 765 to 850. So I'm going to ask. I would take 827, but I wouldn't take. I don't need to fill. I wouldn't fill this unless I thought. If I think IBM's toppy, I would fill that first. If I think IBM is low, I would fill this first. I'm watching my channels too to see where things are going. Now, based on what the Fed just did, I think that everything's going to drop a bit. So I wouldn't be in such a big hurry to spend the money. I want a low price for my 140s. I would be more inclined actually to sell these first and take 825 for the 160. And then I could wait on the rest though. So you have to fill your trades. It all starts off by who's going to give me my price. So I ask for 850 here, and I offer 16 here on the 140. Oh, sorry, you guys are doing it while I'm talking. I see them changing. I would offer 16 on the 140s and ask for 8 and ask for 850 on the other one. And if it fills, I'm going to get 750 instead of 8, and I save myself 50 cents, which is $500. And it's not a big deal. It depends on who you are. It's not a big deal to save $500, but it's a big deal if you do it every time you make a trade. If every time you buy and every time you sell, and you do it 100 times a year, and you save $500, that's $50,000. Even if you save $100, it's $10,000. If you just save $100 every time you go in and out of position, you're gonna get to $10,000 really fast. And if you have a $100,000 portfolio, you're going to boost your portfolio by 10% just by being a little bit better at trading. Ask for better prices. See, it's going down. I knew that would happen. Ask for better prices, and if you don't get your prices, don't take it. There's always another fish in the sea. All right, so when you're getting fills, just be patient. Ask for the money, and if it takes, again, as the thing fills, okay, so in other words, if the call's filled first at 16, I would be concerned that I have naked calls, especially because I'm biased that I think IBM will pull back a bit. So if the calls fill at 16, I am going to be more inclined to take whatever I can on the short call side. So I might offer 8. After they fill, I'm going to offer 16. I'm going to ask for 850. Whichever one fills first makes my next decision. If the 16 fills first, I'm going to be nervous and I'm going to fill quickly, and I'll lower my price on the short call. But if the short calls fill at 850, I'm going to say, aha, I think that guy overpaid, and now I'm going to wait and see if I can get a good price on my short call. Because I'm not as worried about IBM popping up as I am about it going down. But you have to factor in exactly what you think it's going to do in the next few days, and especially, is there going to be earnings? Is there an event? Is there anything happening? You have to think about what's going to happen while you've got these open positions. And on the put side, too, it's like, now, put side's easy. I'm only going to sell the puts if I get a good price. If I don't get a good price, I'm not going to sell the puts. End of story. I just won't sell them. I'll have just a bull call spread that makes 150%. The only reason I wouldn't be able to get my price on the puts is because my bull call spread is doing good. That's the only reason I can't sell the puts is because of things going up. If it's going down, obviously I'm going to get a good price on the puts. It's a definite thing. I either will get a good price on the puts or it means I don't need them because the bull call spread is doing great and I can just move on and take another position. And by the way, I've used no margin whatsoever, so I can go to any other position and start a margin position because I didn't use any margin on this one. All right, that's the logic you got to carry in. It seems like a lot to think about. I'm sure it seems like a lot to think about. It seems like a lot to think about. Oh, Yellen's talking. I forgot about her. She's not helping. I forgot all about her speech. All right, we'll check this out later. Frickin' Russell, man, won't go down. I see notes are popping too. We should play TLT. I didn't even think about that. Anyway, it seems like a lot of stuff, but it's just a question of just getting used to it and thinking about how everything affects everything else. So anyway, how are we doing on this stuff? Let's see. Oh, what was that? That's not so. Actually, it's not that far though. It's only a 10-point drop on the S&P. It's really not that bad. And the frickin' Russell could care less. You bastard. Nice improvement in oil though. That's good. I feel better about that. Oh man, 50.28. I could have cashed out at 50.28. Guys, we told me that. Look at the dollar. Yes, take it. Take it. That was my goal, 92.50. Look at that. That's exactly what I said would happen this morning. Oh, here, did we? Hello?
Bill Bondman to the mortgage market got at 2:32 p.m. Eastern Time, which is a short while ago. Their statement, and of course, we did not raise rates, but they did make an announcement that they're going to start showing the balance sheet as of next month. And so it's going to be real slow and real gradual. We're going to break it down tomorrow's update, but essentially they're going to put caps on what they're going to reinvest over the next few months, and ultimately they're not going to be buying any bonds, and there's just going to let bonds expire on the balance sheet. So with that said, though, bonds are not liking it. They're lower. Prices are now down 16 basis points on the day, down 19 from the different pricing.
These are bond experts that are calling.
So you need to protect some clients. But most importantly, from a technical aspect, we broke below the 50-day moving average, which is not encouraging. It's the first time we've been below the 50-day moving average since July. So you need to lock, protect yourself here, not only against some of the reprice for worse, but potentially for some worsening pricing here. Of course, if anything changes, we will get back to you. Have a great day.
Okay, that's a service for mortgage brokers that I still use in my real estate days because I like their updates. Anyway, so basically they're obviously taking it back. Now I like that because it gives me the what's the popular consensus. Oh, meanwhile I should be selling this. Damn it, where is it? It's so far up I didn't get to it. All right, I'm done. Happy. Whoa, jumping around on me. All right, good. All right, there's $1,500. I don't have to worry about. All right, so I just offset some of the other damage, frankly. I mean, that's what I'm looking for. So now I can go back to worrying about CL. So there you go. That was my, I mean, in the morning, that's exactly what I said would happen. We're going to pop to 92.50. See how easy trading is? Not hard. So now I'm back to, I'm still down $7,000. Let's go popped. See, where's my break even? Oh, that's 50-50. It was right there. Break even. Son of a bitch. Anyhow, so everything's all over the place, but look, the realistic interpretation is this should be it. So back to you guys. Any questions? I wonder if there's been any questions in all of the rambling. Okay, that was the last question. LB. Bill, are you still bullish on XRT? Retail's like this, like a punch. Where do you think of the upside? Is it blah, blah, blah. We did an XRT trade, didn't we? I don't remember it. I thought retail was generally oversold. We got such a big pop, though. See, it just got rejected at the 200-day moving average, and now we're getting to this. I'm not really bullish. I think, frankly, unfortunately, if I took my eye off the ball, I'm sorry. Did we do a straight call? If it was a straight call, then I would have taken the money here. That would have been the smart thing to do. You hit the 200-day moving average from the bottom. Take the money. Okay. As to where it is now, though, I'm confident in the range between the 50 and the 200, and I'm sure if I did a spread, it would have been right between the 50 and the 200. Isn't it in the OLP? Did we actually enter it? If we did it, it would have been the OLP, I'm pretty sure. XRT. Oh, there it is. Oh, yeah, okay. No, see, it's a 30. It's January 37.42. So and we sold the 36 puts. I'm not worried that it's going to go below 36. This is still playable, really. I'm not worried it's going to go below 36, and I think this range 37.42 is going to be right. And as it stands now, see how the moving average is up to 40 already, and it's going to probably continue to move up. And for January, don't forget, it's 3 months from now. So I think that's going to be pretty much right where we're going to be in Christmas time at 42. I wasn't aggressive with my target. Notice that 42 is just above the 200-day moving average. I wasn't being ambitious. I just think we're going to settle in at the top of the range. Christmas will not suck for the retailers. Because look, I mean, what do you got? Look at how many people have jobs. Millions, more people have jobs. Wages are up. We finally have, for the first time since like 1970, we're back to where we were in 1970 for median wages in this country. So that's as good a Christmas as you're going to get. So where do you think the upside? Yeah, like I said, 42 is our goal there. So that's what we're looking for. Bottom 20. I don't know what bottom 20 means. Wait a minute. You're bullish. 20. It can't be $20, right? That can't be right. Raw price apparently going down. Okay. Most self-driving cars use LiDAR plus radar cameras, and Tesla only uses radar cameras. Oh, radar. I'm sorry, LiDAR. That's the thing that they're not using. LiDAR. And apparently it's extremely, like nobody, none of the technical people at other car companies can figure out any way that they're going to make this work without the LiDAR. Short on ATI. In the OLP, we are short on the October 20 calls and the long January 15 calls. The spread is currently 4.995. Oh, an ATI? We're long the October call. Short ATI. Oh, the metals guys. I forget who they are. I'm like, who's ATI? Oh, I love these guys. All right, so what's the question? The question, should we be worried about them? I'm not worried about them at all. We are short the October 20 calls and long the January 15. Only January? Oh, what do we do? Oh, no, but we're only half short. You're right, they're two in the, wait. We have the 15 calls. Is that what you said? It doesn't work what you said. We have the 15. Okay, we're short the 20. There you go. All right. So ATI, we have 10 January 15 calls. I wish they were longer, but they're not. So and ATI is at 20. Is over 20. We're way over our target. I mean, we're probably going to roll them. I mean, that's all. We'll see what happens when we get to it. ATI. See, you can. We could. I guess I took a short-term play just because it's going to be an easy payoff. we have the January 15, which are like $8. We sold the October 20s, which are $3 now. If we wanted to roll these, we could roll them to the 2250s, and those are, so they're like, these are like 230, 240. So for 60 cents out of pocket, we can pick up 250 and strike. And we'd have then the 15, 22, 50 spread. So do we want to do that, or do we want to shut the position down with our $5 that we intended to make in the first place? I don't know. You know what? Right now, I can't tell you that. If the markets pull back from this Yellen thing, if the markets have a big pullback and ATI pulls back with the market, I'm going to not blame ATI. And what's going to happen then is we're going to be able to buy back these calls and then sell something in January. These guys are $2 in the money. ATI would have to fall more than 10% to even be a problem here. So the less we pay these guys when we have to roll, the better. So we're going to have to just wait and see what the pricing is. Now, if ATI really takes a beating, I'll be very inclined to go to a longer spread because I love them long term. But as it stands now, if we go into a month from now and we're way over, let's say they're 25, it won't be worth rolling, so we won't. We'll just shut the trade down and pretty much take $5 off the table. If, on the other hand, they're lower, then this number will be smaller and we'll get a better price for the roll, and then it'll certainly be worth rolling. If they go much lower, so that's if they go lower. If they stay flat, we probably roll them. Because it's a month. That means the market didn't crash for another month. You have to take that into account. So what am I going to do 30 days from now? Well, if the markets do dip and come back, then we're going to be bullish. If the markets dip and stay down, we're going to be a little bit bearish, but I still like ATI long term, so I might take advantage of the dip and take 2 more years. If the market, if it's flat, we're going to probably roll it. If it goes a little bit up, we'll probably roll it. If it goes much higher, we're probably going to have to cash it in. So those are the 4 possible things that could happen. And it's like chess. You just got to think of like the moves ahead. What could I do? What will my opponent do? What will I do if he does that? And what will happen if he does that? And if you're comfortable with all your moves, which I'm very comfortable with all my moves on that one, then there's no reason to worry about it. Sold another Apple put. Yep, sold all the Apple puts. Dollar moving higher. Buy Rolling Stone. Oh, I'd love to buy Rolling Stone. I don't understand. I don't understand why they don't have a TV show, why they don't have a channel, why they don't have a YouTube channel. It's like they used to be. But now, the problem is, though, what they used to be and what they are 2 different things. They turn themselves into like a gentleman's magazine. They're not a rock and roll mag. Rock and roll, first of all, rock and roll is a little bit dead. They didn't move with the time. This is what killed Rolling Stones. They went in the direction of becoming a gentleman's magazine. They followed their audience, which is not necessarily a smart thing to do. Their audience is me, frankly. I mean, I read it when Hunter Thompson used to write Rolling Stones. That's when I used to read Rolling Stone, and it was rebellious and blah, blah, blah. And I got older, and they decided since I got older, they should be acting older too. And I don't think they should have done that. I think they should have just stayed where they were and embraced the punks and embraced the all the new wave stuff, and then embraced the new music and things like that. And they should have been the magazine for the for the new whatever's hip in music at the time, not the magazine for I'm frozen in my 1970s to 1980s music thing, and I think everything else sucks. Not everything though. I'm actually pretty liberal. I like a lot of stuff my kids like, but just you know what I mean. Like I'm not my parents. I work really hard not to be my parents because my parents would like anything that was done after Frank Sinatra was like garbage. They wouldn't listen to. But on the other hand, I'm not the core audience for Rolling Stone. That's their problem. They followed me, but I didn't follow them back. I didn't, even though I still like the stuff. It's like, how many times can I read an article? This is the problem. How many times can I read an article about what Mick Jagger's doing? I don't care. It's not that important to me. It was when I was young. I used to love it because the Stones were active in doing this and that. Now they're a bunch of old guys. I don't want to read about their activities anymore. And I don't mean just the Rolling Stones, the Who, the Beatles. Who cares? It's just, half of their things are obituaries now. So that's why, unfortunately, it's like conceptually buying Rolling Stone as a concept, it would be great to have the cool magazine, the cool rock and roll thing, but I'm not sure that Rolling Stone isn't Rolling Stone anymore. That's the problem. It's just like a memory of something that we used to have. Fed's crazy market, picked up some TZA. What's the new buy level for Apple, given that you see the downside till the reports? Just when they hit their thingy, their lower band. Where is it? Probably 140. Yeah, I said 140. Yeah, 140. So they'll come here and probably test it. I mean, unless something shockingly bad happens, this should be fine. And then they'll have earnings, and people say, "Oh my God," like go back up again. But this is, happens every time around Apple. Whenever there's an excuse to take it down, the bears attack it. They try to bring it down. They're not trying to bring it down because they hate Apple. They're trying to bring it down so they can buy Apple. It's very hard to buy Apple cheaply in bulk because every time you buy it, the price goes up, and the more you want to buy, the more it goes up. So if a big hedge fund is trying to buy $100 million worth of Apple, it's better for them to put out a few negative stories and then buy it. It makes it a lot cheaper to buy it. Selling off good now. What? Am I missing something? No, that looks up to me. I guess it depends when you wrote it. Wow, how insane, huh? They're doing the Q&A, so who knows? Every question she answers, the market jumps up and down. That's like I said, you got to just ignore the noise and then wait for things to settle down. What are you target on the Russell short? I don't have a target to everything. I expect it to go down at a certain point, and then it'll stop going down. And then when it stops going down, and I think it's done, I'll get out. If you look at where we are, though, look at the hourly. Okay. Basically, we've had a run from 14 to 1440, which is 28. Would have been 56. So 10% up from 10% up from 14 would be way. Oh no, I'm sorry, that's way much. 1% is 14. Sorry, 1% is 14. 2% is 28. 3% is 28 plus 14, 44. Okay, so that's where we are. This is 3%. The 2.5% line is what we care about, and that's going to be 1400 times 1.025. The 1435 is the 2.5% line. I certainly, and in fact, oddly enough, that turns out to be exactly my break even on my Russells, and for good reasons. So see 1435. So I've already done that calculation when I added to my position. So 1435 is a 2.5% line. So I expect at least we're going to retest that. And you can see how we kind of paused here, had a little teeny pullback, then shot up through it, and whatever. So 1435, this line, is the 2.5% line from the run from 1400. So this is what you call an overshoot. Now, it's 35 points up. A 20% retrace of a 35-point run is 7 points. Okay? And a 40% retrace, a strong retrace, would be 14 points. Now, the same goes for an overshoot. So you could have a weak overshoot would be 42, right over here. That's the first overshoot of that run. The second level, which is very rare to have a strong overshoot before a pullback, but a strong overshoot is going to be 49. So I don't expect it to break 50, which is why I added to my position when we're up here. So I don't expect it to break 50. I expect it to first pull back to 35. Then, if it's consolidating at 35 and looks like it's, and if it's down C at 35, if the fall from here to 35 produces a strong bounce, then it's probably going to go back up. If it produces a weak bounce and looks like it's breaking under, then I might stick with it. But as soon as it goes over a weak bounce, I'm going to give up. And I'll take a small loss above 35. But I'm hoping it's going to crash right through 35, have trouble getting back over, and then continue down. And then from there, you're looking at the strong retrace of 35. Again, 35 is the baseline. Then we'd look for a 7-point retrace from 35, and that's going to be 28. So I expect 35. I hope for 28. In fact, you can see right here, 28. So we could have done this exact same math at the beginning of the rally, and the lines would have been the same. You said, where is it going to go? I would say, well, it's going to go to 28. If it's going to go at a 2.5% run from here, then this is what could happen. And then 28 would have been the line that we would have already charted, because that's a weak retrace from the run to 35. So consolidating along the weak retrace line is actually a bullish sign that it's probably going to break higher. That's why you always have to be aware. That's what the 5% rule we talk about. You always have to look at what your 2.5%, 1.25%, and 5% lines are. Those are very critical. From there, you can make the rest of your calculations. And you can literally, I do it sometimes, but it's tedious. But you can literally chart these things in advance. I mean, it's like you don't need to see the rally. I can draw these, like we did with the oil at the beginning of the month. I drew these lines ages before the oil actually moved. I said, this is how it's going to move. And it's exactly doing what we thought it would do. It's just that it's sticking a lot more than I thought it would. Well, they're coming back now, thank goodness. Where were we? Oh, questions. Right, we're doing questions. Phil LD, very nice, good job. Thoughts on Apple in terms of near-term price support? Again, they're going to attack it and attack it and attack it, and Apple never responds. Don't forget, Apple, you take advantage of Apple because Apple does not respond. They do not comment on stock prices. They do not comment on negative commentary. So you can say anything you want about them. You can make up any kind of bullshit. You can lie about anything you want. It doesn't matter. They won't say a word. Their attitude is that we let our numbers speak for themselves, we let our sales speak for themselves, and everything else is bullshit. And if you're going to invest in Apple, you have to have the same attitude. IBM provided they get to 160. Oh, yeah. We're just having a debate with that because we're doing this. We're setting up a hedge fund, and Doug, who's our head trader, he's we were talking there. We were sitting there with a lawyer talking about what you can and can't do, and so on and so forth. And it's very tricky because, like IBM, their marketing, PR people, whatever, investor relations people, they call me. They're dying for me to write them up ahead of earnings, and I don't want to know. I mean, that's been my stance for a long time, is I don't want to know. And I said to Doug, I said, IBM wants to tell me, like, all this crap ahead of earnings. He's like, don't tell me. It's crazy. But, and again, they're not going to tell me anything illegal, but they're going to make sure I know this point and that point and that point. That's the job of investor relations. They want to make sure that an analyst like me knows, here's our high points of what we're working on, and so on and so forth. Now, he doesn't know me. He only knows that I'm a popular writer. But he wants to influence me, obviously, to say good things about IBM. He wants to pre-spin their numbers so that I view them in a positive light. That's obviously his job. He doesn't know me because if he does get me on the phone, which I so far, for 3 quarters in a row, have blown this guy off. But because I don't want to know. It's like I don't want to know because it makes me very nervous to know anything that I shouldn't know that isn't publicly available. I like to get my information from the public, and because I talk about it, and I don't want to ever be accused of like doing something inside, and I certainly don't want to be accused of cozying up, the companies. Like after I interviewed the CEO of Coca-Cola, they offered to fly me down to Atlanta and see the place, and that would have been cool, but I can't accept stuff like that. You know, it's like I know a lot of people do, but I mean, I can't do that. It's terrible. It makes you feel, even if I say, oh my God, I would never, change my opinion on something. It's not true because you're beholden to somebody. Somebody sits you in a first class seat and puts you in a nice hotel and gives you a tour of their facility and takes you out to a nice lunch and blah blah blah. It's always going to change your tone on them. You know, there's no way to avoid it. You know, or even worse, then I would like start saying, oh, I should be more critical because they did something nice to me. But then it's like, you know, then you're being overly critical for no good reason. So the best thing to do is to avoid these people. But it was funny because for the hedge fund purposes, Doug was like, don't even tell me about that. He's like, don't even tell me a word from something like that. He's like, I don't even want to know you met somebody like that. So, you know, you got to be careful with all these companies. And it's, you know, with IBM, it's very complicated. They're in a very long, drawn-out turnaround where they're pivoting the company way more towards the artificial intelligence area. But they still file more patents than any other company in the world by a mile. And they're a company I would always want to have in a long-term portfolio and always be invested in. So whenever they get cheap, whenever they go down in a channel, I want to buy IBM. How are we doing on time? Oh, we're way past. All right, got to wrap it up. I got the up trade from the Morning Post. What's your target? Oh, I'm done. I mean, I just got out. See, that's the problem. That's why the futures are so much better. I just got out with a nice profit of whatever the hell we made on that. Let's see how up did. Wait, I'll tell you. DX. All right. So, $1,500 profit on 2 contracts. Done with that. And the up trade, on the other hand, what did I say in the morning? Fed day folly. But the reason I picked that was because it didn't have a lot of premium, so hopefully it did good. All right. Control that. Okay. October 2350 calls for 45. So how do we do? Ah, 60 cents. Come on. You made 33% in a day. You greedy bastard. What's my target? My target is take 33% profit in a day. Do that every day and you'll become a multi-billionaire in no time. You know, that's very true. You guys, okay. It's not realistic to make 33% in a day. Okay? If you make 33% today and 33% tomorrow and 33% the next day, you will be a billionaire. Even if you start with like $100, you'll be a billionaire before the year is up. It's not possible to make that much money every day. So when you're like, wait, anything more than like 5% in a day, you should be like, oh my God, that's fantastic. I mean, I understand something might move on news or whatever and be the way you want it. But all I said was, I think the Fed is going to be tighter than we thought. They didn't actually raise rates. All they did was end the QE program or taper down the QE program. It isn't even as much as I wanted, and the dollar still got the pop I wanted. So get out. That's it. Freaking 33% a day is I don't know what else you can do. Are you going to make 33% tomorrow? No. What's the chances of making 33% and then making another 33%? It's over. Now we'll find another trade. You know, get in, get out, get back to cash. That's why I'm the thing. I don't care if it goes up further. I made the easy money. I made a quick $1,500 a day trading 2 contracts with 0 effort. That's how I like my days to go. What would you recommend in this bull call spread in TIBA for? I mean, even $1,000 a day for the year is like a couple $100,000. It's fine. What would you recommend as a bull call spread in TIBA for a new position? Wow. Oh, that's easy pickings. Okay, hang on. Good time for a new position. Blah 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 blah. Okay, TIBA, yes, because TIBA is still not catching a break. Last one. This is it. I gotta go. So Teva almost got away from you, and you actually lucked out with having a nice pullback right now. It's a long, drawn-out process. They may stay low for a very long time, but that doesn't mean they're not a good price here. And I think Teva's got 2020. So anybody who's got 2020, get some huge money in premiums. Nope, they don't. Sorry. All right, no 2020s. Still. See, I would almost go high on the put, but let's be conservative. In a conservative play, if you sell the 1750 puts for 350, okay, you can use that as a base. And this is so crazy cheap. I mean, you can buy. Let me see. If I want to do a half sale, let's say I'm willing to buy 1,000 contracts for 1750. So I'm willing to spend $17,500. So I buy 1,000. I sell 10 puts for $3,500. Now, what do I want to do with $3,500? I could buy these calls at 1750s. I'm over the money. And I don't like being over the money. I like to be in the money. Is it worth spending $330, $450, so $1.20? Is it worth spending $1.20 to be $250 lower? Oh yes, it is. Now, given that I've said that, can I spend another $1.20 and be another $250 lower? So I'm at $450 here, and this would have to be $570. It's much higher than $570, so that's where I stop. So the $15 calls are $460, let's say, $455. Well, basically $455 right now. So $455, and now what do I want to sell? 15, 20s are going to give me $250 back. That's going to make it a $2 spread. But why wouldn't I go up here to get? Now, see here, I'm getting $250 more in the spread, or $1.70. And the only reason I wouldn't do that is if I think Teva can't get back to $22. But in 18 months, or is it 18 months, or less than 16 months. In 16 months, I think it's definitely worth the risk of collecting a little bit less money. So the spread I would go for is the 15s at $460 or $455 minus these guys at $170. So that's $455 is going to be $385, $285. So $285 for this spread, and if you sell these guys for $350, that's $175 off $285, which brings you down to $110. So it's $110 net for your longs, which are 15, which are 750 long. So again, you have 2 times that many. So what I'm saying is you could sell 10 of these and buy 20 of these spreads. Your net's going to be 110 times 20. So your net's going to be $2,200, and it's a $15,000 spread. But it's a $15,000 spread that's 20 times 2 in the money. It's $4,000 in the money to start. So officially, that would be the spread I would go for on this one. All right. On that note, we will wrap it up, and we'll do it again next week. It's been a lot of fun, and I'll get back to chat. We'll talk about that. And the Dow's down again. Isn't it funny? It's gonna be so much fun watching this now. But the index is for sure short. Everything short. Look. That's it. It's over. The free money is over. That's what the Fed just told you. It isn't sinking in, but it's over. And it may take a long time. People are going to start realizing that because, this all doesn't happen. The amount of trading that's going on right now is nothing. The decisions, now they're going to have meetings. They're going to watch. They're going to digest what she's saying. Tomorrow morning there's going to be a big meeting at every fund, and they're going to sit down with all their guys, and they're going to talk about it. And they're not going to make a decision tomorrow morning. They're going to have people analyze stuff. And they're going to run the numbers and crunch the situations and look at the scenario. And a few days later, they get back to it. And then they come back again. They have another meeting. It takes a while for the market to really change direction. There's a lot of people having a lot of meetings and people running analysis and doing all this stuff. Just arrive at the point that I'm telling you now, short everything at these positions. So you have especially 1445 on the Russell, which may go to 1449, but over 1450, I'm wrong. So 1449 should be the top on the Russell. That lines up with where we are now on the Dow, which is 2325. It's 2350. Anything below 2500 on the S&P, that is the easiest stop line in the world. You go below 2500, start shorting. If it's above, get out. And on the NASDAQ, well, we talked about 6,000 being an incredible. It was at 6,000 earlier today. What a great, that's a great line on the NASDAQ. You blew that one. But you can still do 1445 on the Russell. And the Nikkei is loving the strong dollar. But it'll follow the Dow down. So that gets interesting. If this thing keeps going up, it'll be a very interesting short at like 20,500. Because the Nikkei loves the strong dollar, but then if the Dow goes down, the Nikkei is going to follow the Dow down, even though the dollar is strong. It's a weird sort of relationship they have. It's an unhealthy relationship. All right, well, we'll do it again next week, guys. Best of luck, and I'll see you inside. All right, take care.